It's time for Yahoo Finance's Market Minute. Stocks moving to the upside, looking to build on Wednesday's post-Fed rally. Shares of China's PDD turning positive. Shares initially falling after missing earnings expectations. Its profit growth slowing amid weak domestic demand, tough competition, and uncertainty around trade tensions between China and the U.S. And shares of global consulting firm Accenture under pressure after the company's CEO said the government spending cuts by Elon Musk and Doge are hurting the company's sales, saying, quote, during this process, many new procurement actions have slowed, negatively impacting our sales and revenue. And electronics maker Jabil rising after topping expectations in its second quarter and lifting its 2025 profit and revenue forecast. The company citing surging demand for AI data center infrastructure as a tailwind. And that is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, we're going to dig into the latest market action and discuss the personal finance moves to make amid this volatility that we've been tracking, and what the latest unemployment numbers tell us about the health of the jobs market. We discuss the Glassdoor's senior economist is going to join us here in studio on that. Plus, housing hurdles. We'll talk about what you need to know about the spring home buying season. Realtor.com's chief economist joins us for that conversation. All that and much more during today's show. But first, let's take a quick check of the markets. We are 90 minutes into the trading day. Stocks rising right now, bolstered by dovish signals from Fed Chair Jerome Powell at March's FOMC meeting. And we're also seeing some solid housing data that's easing some concerns heading into the spring season. Here to dig into the market moves, we've got Lisa Schreiber, who is the investment analyst over at Gradient Investments. Great to have you here, and thanks for joining us on the show today, Lisa. First and foremost, as folks are checking their portfolios amid some of the volatility that we've been tracking, what is your word of wisdom that you would be offering to them during this extended period of time?
Yeah, Brett, thank you for having me. First of all, I would say it has been a few rough couple of weeks for investors, right? It's always hurtful to look at your portfolio and see your investments down. What I always trying to mention here, and it might sound silly, but hey, take a deep breath and zoom out a little bit, right? And when you look at it a little bit more high level, then we see, hey, even after two fabulous years of 2023 and 2024, where we see plus 20% growth in both years, which actually hasn't happened since the late 80s, which is fabulous. We also saw some form of correction, right? So correction is a normal part of the cycle. This is nothing we have to be afraid of, but it is something we need to be prepared for. So zoom out a little bit, reassess your risk level, maybe rebalance your portfolio, right? Especially, like I said, with outperformance of equity over the last 2 years, your equity part of your portfolio might be a little bit overweight with what you might feel comfortable with. So rebalance that. But our theme for 2025 is protect, but still participate.
Okay, and so as you are protecting, but still participating, what are some of the pillars right now that you see driving this volatility, and how can investors add apt protection into their portfolio? What areas of the market should they be looking to?
Mm-hmm. When we see at the reasons for the volatility, I mean, there's a lot of policy uncertainty going on, right? That's basically the main driver of all that. And what the market does not like is uncertainty. That's what we are seeing over the last couple of weeks. And when we look at the near-term future, that probably will stick with us for a while as we move forward until we have some more certainty about numbers, tariffs, as they're coming in. What actual impacts do they have on the economy? Maybe putting a little bit of upside pressure to inflation. So that will probably stick with us a little bit. But when we, again, zoom out a little bit, look at U.S. equities down for the year still, then we see still some pockets of financial markets are working quite well this year. And when we look a little bit beyond U.S. borders, for example, international markets, that can be a form. And I think that is evidence for the value of diversification, right? That's the evidence right here. Diversify and do not put your nest egg in one kind of a basket. So that can be a form of protection. Look a little bit beyond. Again, reassess your risk level that you might feel comfortable at. But again, there's still, when we stay in the US, a lot of sectors and pockets that might look opportunistic. And what we're focusing in uncertain times is quality and the leaders in their respective spaces where we can still see opportunities.
We just had the interest rate decision yesterday from the Fed, and of course, we got the summary of economic projections, the dot plot really giving us a sense of where they believe we could continue to move on the policy side from this juncture, or where they anticipate we might end out the year. And then on the other side of this, we continue to keep in mind that their best gauge for inflation right now that they're combating is PCE. And so with that in mind, is that the investors' best gauge as well, or is there another data point within the economic data that investors should be positioning their portfolio around to give them the best sense of how the Fed may move?
Yeah, I think overall, I mean, we got some color from the Fed yesterday. The market seems to like news they were already anticipating, right? They were anticipating a continuous pause, which we got. The positive news here, I think, was that investors reacted to was, hey, we're still on path for 2 more rate cuts this year. Even if the commentary around economic growth came a little bit down, I think what the consumer and what investors want to focus on is especially some future data points, and we are moving there as we are seeing the impacts of tariffs on prices and a potential upward drift of inflation, which can elongate the Fed's move downward with interest rates a little bit longer.
Certainly. There are 2 picks that you sent over to us. You've got one of them being SLB, you have another one being TE Connectivity. Break those down for us.
Yeah, SLB, a pick of us in the energy market, and we see opportunities in the U.S. energy market at the moment, energy sector, right? You want to be certainly very, very careful where to look at amidst tariffs and still policy uncertainty that influences the energy sector. But SLB, world leader in oil services company, diversified globally. They only receive 20% of their revenues from North America, and with the rest globally diversified. And also they're the world leader in carbon management and digital integration. So they are really in every single corner of the energy sector. And when we look at valuations, the stock hasn't done much over the last year. And when we look at valuations on a next 12-month PE ratio, this can be an opportunistic pick and is still very reasonable compared to its growth prospects.
Lisa.
And when
certainly. Please finish the thought.
Yeah. And when we look beyond the U.S. borders, like I said, diversify a little bit, maybe give international developed stocks a second look. We like TE Connectivity. Again, a world leader, world leader in sensors and connectors that of products that we basically use every day. And I think you might sense a theme here. We like leaders in their respective spaces. We like quality. And they're also very much diversified in every single region. They get a huge tailwind from AI data center build out, energy consumption that is rising with AI build out. So they're getting a nice bump there. And again, bringing it back to valuation still seems reasonable given its growth.
Lisa, thank you so much for breaking those picks down for us. Really appreciate the time today.
Thank you for having me.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Yahoo Finance senior reporter Alexandra Canal. Ali, we got to talk about buy now, pay later firm Klarna. This one is landing and partnering up with DoorDash. In the coming months, customers will be able to use Klarna services to purchase groceries, retail, and a Dash Pass annual plan. And customers will have the option to pay for their purchases in full in 4 equal installments or defer payments to a more convenient time here. Shares right now of DoorDash up by 1.5%.
Yeah, and I'm not proud to admit this, but I am a Dash Pass member.
Really?
Yes, I am.
How long? Member since?
Like 2 years now.
Okay, since 23.
It's a good deal. It's a good deal. But for DoorDash, this is their first buy now, pay later partnership. We've seen this shift in consumer sentiment, this decrease in consumer confidence, this expectation that we're going to have inflation elevated over the long term. And we know that a lot of consumers, they've been pretty squeezed when you go to the grocery store. So the fact that we're seeing this buy now, pay later partnership for DoorDash, I think could be a positive, hence the share uptick that we're seeing today. But this is also coming ahead of Klarna's expected IPO, and I think just partnering with, more of a sexy name like DoorDash, a name that people know and recognize, that could potentially get some retail investors on board to potentially invest in this stock. And this comes just a couple days after they partnered with Walmart, and Walmart had a previous partnership with Affirm, which was a Klarna competitor. So right now, Klarna is just wheeling and dealing ahead of this IPO.
Yeah, they certainly are trying to at least show to the street that they have a lot of power to throw around within this buy now, pay later landscape, and with some of the biggest retail partners that are out there for many consumers. For Walmart, within a 10-mile radius of 90% of America, and then for DoorDash, used by Ali Canal.
Used by me, and I do think it gives you some good deals depending on how often you use it. But I'm trying to cut back. I'm trying to cook my own food.
Look,
it's hard in the city. Sometimes you're busy and you just got to order that chicken parm.
Yeah, they got me hooked. All right, next up, let's talk a little Apple here. This is an interesting one on the day. Apple is reportedly losing more than $1 billion a year on its streaming service, Apple TV Plus. That's according to the information. Shares right now still holding on to fractional gains. They're up by about 0.5%. I mean, you're tracking this entertainment landscape. This is a big deal to be losing $1 billion on something that you're putting out there to try and make the ecosystem that much more sticky for all of the install base.
The fact that they even have $1 billion to lose on this, though, I think is a sign that we see a lot of these tech giants entering the entertainment space, not just Apple, but also Amazon, and they just have the capital. They have the money. They can experiment with things in a way that some of those more pure play streaming platforms like your Netflix, for example, they really can't. But it is coming at a time where Apple stock, it's been sort of reeling over the past few weeks amid this tech sell-off. It's shaved nearly $700 billion from its market cap since its record close. And then you have this announcement that it's bleeding money on the streaming side. And really, that was a big play to keep people within the Apple ecosystem when you think about the services side of the company. But, when they first launched Apple TV Plus in 2019, they spent around $6 billion when it comes to, grabbing some of the top producers, the talent.
Right.
They had a very limited library, and they continue to have a limited library. Shows like Severance, though, Ted Lasso, people love those shows. But I don't know if their library is deep enough to really keep users on that platform. And to that point, Antenna sent me some data that showed for the month of February, Apple had some of the highest churn levels compared to those other big streaming platforms out there. You're seeing on their screen, 7% of users churned out of the service during February. You compare that to Max and Hulu. The weighted average, so that compares all of those streaming services, was 5%. So above that weighted average, and then you look at a Netflix, only 2% churn. And if you think about the number of subscribers, Netflix has, over 300 million subs. There's estimates that Apple TV Plus has around 40 million. They don't break that out specifically. So it's sort of apple to oranges in a lot of ways. But as we're entering this new era of the streaming wars, you could say, there's a lot of emphasis on maybe potential consolidation in the future. Right. And if you have a service that isn't profitable and users aren't committed to staying with that service over the long term, I wonder what that means for the future.
Well, it's noteworthy as well because you think about the amount of accounts for Apple TV Plus that are actually subsidized on the first sign up because you're either buying a device or you're signing up for some other subscription, say it be a phone provider or something else that gives you that type of access.
And that was a big issue in the beginning because a lot of folks got free Apple TV Plus memberships for around a year. So it sort of speaks to this point that maybe at a certain time, they're going to either have to raise the prices or maybe crack down on some of those promos. Yeah. But, you have to have the content to justify that.
That's true. All right, Ali, thanks so much for breaking these down with us. Economic uncertainty is fueling volatility on Wall Street, and that has many wondering how to navigate the wild swings. Joining me now, we've got Jesse Nino, who is the Edward Jones financial advisor. Jesse, great to have you here with us. You say it's important to prepare for market downturns, both financially and emotionally here, and my mood ring certainly is on the constant adjustment here. So walk us through that.
Yeah, thanks, Brad. Thanks for having me. So when we're working with clients today, yeah, there's two really main themes that we're talking with them about: preparing ourselves emotionally and also preparing ourselves and our portfolios financially. So when we think about preparing ourselves emotionally, one of the biggest things that we can remember right now is that regardless of what's causing this volatility, we know that we experience about a 30% drop in the market every 3 to 5 years. And we haven't had one since March of 2020. So that's 5 years, meaning that it's just best to prepare ourselves that this volatility may continue. The second thing we try to remind our clients of to prepare them emotionally is that, you know what? Every single time we have a down market, it is followed by an up market, and those up markets are typically longer and stronger. And then lastly, just looking at the most recent volatility, we did hit a 10% drop in the market. We know that on average, we have about 5% drops a year and 10% drop, and that's still considered perfectly normal volatility.
And so with all of that in mind, how can investors smartly take advantage of some of the downturns that we see in the pullbacks?
Yeah. So there's a couple things that investors can do to take advantage of these pullbacks. Number one is this volatility inevitably creates some imbalance in your portfolio. So just great opportunity to look over the diversification, reassess your comfort level with risk, your time horizon, and your spending needs. The other thing we can do to take advantage of this portfolio is consider some tactical moves like boosting your contributions to your 401k, your HSA, or this might be a great time to consider some of those Roth conversions while those share prices are down. And then lastly, just hoarding cash, as we say, or putting some hay in the barn. We like to have extra cash on the side to prepare for any unknowns or also take advantage of some of those share prices being down.
So with that in mind, if you have a retirement that is perhaps a week, 2 weeks away, or maybe you're in retirement right now, my goodness, and you're drawing upon some of this cash that you've saved up or these positions that you've saved up and continue to accrue upon, what is your down market strategy?
Yeah. It's really important that every investor have a down market strategy, but even more important when you're drawing that income. So number one, best thing to do if you're starting to feel panicky is just pause and make sure you're engaging with a professional financial advisor before you make any major changes to your portfolio. The second thing that you can think about doing is shifting the source from which you take your income every month. So maybe you're shifting your income to come from cash reserves, or even dividends and interest during this time, or perhaps you're starting to sell some of those bonds or bond funds that generally hold their value better when the stock market's down. The last thing we'd say it's important to do is just double check that reliance rate, making sure that you're not drawing too much out of the portfolio so that the portfolio can make a full recovery when the market returns.
Jesse, thanks so much for taking the time here with us today.
You bet. Thanks for having me.
Coming up, the latest data shows that the labor market right now, it remains relatively strong. So why are workers so stressed out? We've got an expert from Glassdoor joining me in studio to discuss next on Wealth. President Trump is set to sign an executive order dismantling the Department of Education. The agency oversees several key aspects of the public education system in the U.S., including providing and servicing federal student loans and providing about 13% of funding for public schools. It also oversees special education. The NAACP responding to Trump's decision in a statement saying, quote, "This is a dark day for the millions of American children who depend on federal funding for a quality education, including those in poor and rural communities with parents who voted for Trump." Already, 19 states and Washington, D.C. have sued the administration over cuts to this department, claiming the agency can no longer function. However, there's one big issue with the president's plan. 60 senators would need to vote in favor of the proposal to abolish the department. That means Republicans would need 7 Democratic senators to vote in their favor. Initial jobless claims for the week ending March 15th came in at 223,000 versus the 224,000 that economists were expecting. Generally speaking, jobless claims have hovered between 200 and 250,000 claims per week for the past year, but workers are increasingly concerned about the labor market. According to the University of Michigan's preliminary consumer sentiment survey, consumer expectations that unemployment will increase are at their highest level in 6 months. Joining me now in studio to break it all down, we've got Daniel Zhao, who is the Glassdoor senior economist. Okay, so let's start with the jobless claims, because it seemed like we were getting back to and really hovering at this pre-pandemic normal that was somewhere in that 200,000 ballpark. Is it still healthy from what we're seeing at this juncture?
Jobless claims are still painting the picture of a job market where layoffs have not spiked. They haven't really increased to the level that you might get if you're just reading the headlines, right? And I think it's important to remember that even though you might see a headline about a massive layoff at a large company, a lot of layoffs happen at small companies, at mom and pop shops that might have to shut down. And overall, the picture that we're seeing is that layoffs remain relatively stable, and in fact, by some measures, are still a little bit below where they were before the pandemic.
So what are you seeing right now in the sentiment among workers at this juncture?
Well, with Glassdoor data, what we see with our employee confidence index is actually a record low in how confident employees are in their employer's business outlook. So just 44% of employees had a positive business outlook in February, which is the lowest stretching back to 2016 when our data begins. So clearly, even though some of the headline indicators about the job market might be healthy, workers are not feeling the same way.
What were some of the largest pain points that were elucidated between the survey data and the data points that you studied?
Well, I think the big problem that workers are facing right now is that they're feeling a lot of anxiety, especially about the economic uncertainty that we're hearing so much about in the news. So, for example, when we look at when we look at Glassdoor reviews that mention layoffs, those are up 5% year over year. We see that there's a little bit of an uptick in some of the reviews that talk about recession, that talk about inflation. And overall, I think the theme so far in 2025, not just for investors and executives, but also for workers, is uncertainty.
You know, I saw this study from Headspace here, and it found over half of employees have considered quitting due to their mental health. Is work more stressful than it used to be, kind of broad brush from the data that you're seeing here?
Well, I think that we are seeing a lot more workers talk about mental health and well-being in the workplace. In fact, when we look at Glassdoor reviews, we do see more workers talking about things like well-being, empathy from their leaders, setting boundaries, burnout, it's more of these mental health topics. And to some extent, you could read that as, well, work is more challenging right now, and I think there is a lot of anxiety. But I think maybe the positive spin is that workers also feel more comfortable nowadays talking about mental health in the workplace with their peers, maybe with their managers. Obviously, it's still a sensitive subject for many people, but we are seeing a lot more people willing to talk about it in the workplace.
What should anxious job seekers be doing to find their new position? Or right now, is this kind of an uncertain job market just holistically from what you're seeing?
There is a lot of uncertainty. There's a lot of anxiety right now. So I would say that the first thing to do is to step back and take a deep breath, right? We always talk about with investors, we say that time in the market is better than timing the market. And that's actually applicable too for the job search. Like, you don't necessarily want to burn yourself out by getting too focused on how things are doing this week or this month. Because to mix metaphors, it's a marathon, not a sprint, right? You have to make sure that you are staying healthy in terms of how you're approaching your job search. And then on the more short-term side, I think it's really important for job seekers to do their research. There are always parts of the economy that are growing or shrinking, no matter where the business cycle is headed. And so there are those companies and industries out there that are hiring. It's just a question of doing the extra legwork right now to find them.
What is the skill set, the number one skill set perhaps, that regardless of the industry or the type of company that is hiring, can make you stand out more right now?
Well, I think strong communication is really important, and that's something that's probably going to be even more important as we think about this world of AI. Everybody's got to mention AI nowadays. But that human element, that ability to not just convey the information that you want, but also to understand what the other side is trying to get out of it, I think those skills are absolutely crucial to a whole bunch of different domains, a whole bunch of different industries. Doesn't matter whether you're a customer service rep or you're a senior director of marketing, like, those communication skills are fundamental.
Excellent. Daniel, thanks so much for joining us once again in studio.
Thanks for having me.
Appreciate it. According to the Atlanta Fed, the pay gap between employees who stay in their jobs and those who switch has decreased. In February, job switchers saw a 4.8% pay bump compared to 4.6% for people who stay in their jobs. If you look at this chart, you can see the lines getting closer and closer together. So what's behind this narrowing gap? Here with more, we've got Yahoo Finance senior columnist Carrie Hannon. Hey, Carrie, what have we found?
Hey, Brad, great to be here. I think what's happening here from the economists and others I've spoken to about this is, it's no longer a great lure to ditch your job to go elsewhere like it was coming out of the pandemic, So there was that big gap that ballooned as, the Great Resignation and there was such a crazy job market there where employers were just trying to get people into the offices. So, or back to work, I should say, I'm working for them. But what happened there is they, really ballooned the wages, right? So this was trying to lure people to come. There were big starting salaries, and it was very exciting to make that jump. But what has happened is employers realized that many of them felt pretty burned. People made that jump, but they didn't really stay that long. They went for the big bump in salary, but and the companies forked out a lot of money for that, but the employees didn't stay. So, they left them again for another opportunity. So what there's been a mind shift. So instead of focusing on getting people in the door with these big flashy salaries, they're going for the long game, trying to find policies and offering benefits that will keep people there longer to retain their workforce. So not as much focus on the big increase in salary, but actually giving benefits. Yes, there's still bonuses, but they're offering things, focusing on the healthcare benefits and other benefits that really will keep a worker invested in that company and want to stay there. And also they had a lot of pushback from existing employees who were like, whoa, people are coming in at these big salaries and they're getting so much more than me. And there was a lot of unhappiness in the workplace. So I think those are the big factors as we're seeing a shift towards how employers are attracting new talent because they want them to stay. So it's more than what that pay number you're seeing.
Yeah, all really good context. Carrie, what do we know about people not only switching their jobs, but switching their careers or industry entirely?
Yeah, that's one of my favorite topics. So, according to ZipRecruiter, say 30% of workers say they want to jump to a different industry, to switch completely. And in the reality, 50% of them in new jobs actually went to new industries. So, this is kind of exciting. And what, again, this reflects back on those pay numbers is because often when you switch industries, you do take an initial pay cut. And this is a fact. You will get back to where you were, but if you're shifting completely, this is quite normal to take a step down initially because there's so many more reasons than pay why you may be switching. You're following a passion, you want a less toxic work environment, you want to work remotely. There's all kinds of reasons to switch industries and really go off in a new target. And coming out of the pandemic, a lot of people did that soul searching about what is it that I really want to do? What turns me on? So I think this is an exciting area in the job market that doesn't necessarily show up in the numbers as people shifting into new industries. And the key really there is there are jobs being invented in industries we've never even thought about before. So LinkedIn has a great Jobs on the Rise that recently came out that may give you some ideas, but it's about staying open to opportunities and continuing to add to your skill set. And really, as Bono and U2 says, don't get stuck in a moment. Don't try to replicate your old job. Go open it. If you're looking for something new, open it up. Open up your mindset and see what's out there.
Yeah, absolutely. Great reminder there on Bono as well. Appreciate it here. Well, progress, certainly. Progress on the narrowing gender pay gap has stalled. According to new analysis from Indeed, women still earn 83 cents on the dollar compared to men, and that equated to $217 less per week in 2024. Joining me now, we've got Priya Rathod, who is the Indeed career trends expert. Good to have you here with us, Priya. The gap has been at this level since 2019. Walk us through some of the findings from this report.
Yeah, so you mentioned it. Nice to meet you, Brad, by the way, that, the gender pay gap is widening and women are continuing to make less than men. And it's the worst it's been since 2019. And what we're finding is it's particularly pronounced at the occupational level. So especially within sales and professional roles, we're seeing men make 30% more than women for those same roles. So the underrepresentation of women in these higher paying roles, coupled with the systemic pay inequities and disparities, they continue to fuel inequality in earnings across various industries. But what we're also finding is that other factors impact how workers experience this gender pay gap. The first of which is age. So the labor force participation rate between men and women widens with age, particularly during parenthood. This was especially apparent during the pandemic when we saw millions of women exit the workforce due to the lack of available childcare. Race also plays a role. So the gender wage gap persists across all racial groups, with Asian men earning 23% more than Asian women, followed by gaps of 16% for Hispanic workers, 15% for white workers, and 14% for Black workers. And then there's the matter of education. The gap widens with education level as well. By late 2024, men with advanced degrees earn 25% more than similarly educated women. So we're really seeing this across the board, and it's exacerbated by things like age, race, and education.
So what role do employers play in closing this gender pay gap, especially knowing many of them, not many, but there have been some very noteworthy rollbacks that we've seen in diversity, equity, and inclusion efforts, and part of that was an effort to also close the equity gap.
Absolutely, Brad. That's a great question. And employers really do have a responsibility to do their part to help close this gap and create these equitable workplaces where everyone can thrive. And so the three key barriers that employers can address are as follows. Number one is pay transparency. As of February 2025, 60% of job postings on Indeed contain salary information, which is great because that is up from just 18% in 2020. So pay transparency really helps women become better equipped to ask for what they deserve, negotiate fair wages, and it really does keep employers accountable. So that is a huge one. The second one will be no surprise to you, and it was mentioned earlier in your segments, but remote and flexible work. Across all age groups, women consistently cite the ability to work remotely as a critical factor when they're considering job opportunities. In fact, Indeed data shows that 57% of women ages 35 to 44 have applied for a job specifically because it was fully remote. And of that group, 48% had children under the age of 18. So again, remote and flexible work is key for this audience. It's important to note as it relates to flexible work that the demand is increasing, but unfortunately, the supply is decreasing. So remote positions have decreased since 2022, and they only account for 8.3% of all advertised positions on Indeed. So this decline is really indicating a shift towards in-office work again. And then the last key barrier that employers really need to address is family leave benefits. So mentions of employer family-related benefits are increasing on Indeed, which is great, but they are still rare, with only 7% of our job postings mentioning paid family leave. And as we all know, without adequate paid family leave, many women are forced to take career breaks that impact their long-term earnings and may even prevent them from re-entering the workforce in the future.
And so just lastly, while we have you here, because I want to give women some actionable tips out there and help everybody empty the quiver of all the arrows that they can throw at new opportunities in their negotiation. What are the top tips for advocating for equal pay in those negotiations?
Yes, Brad. First of all, know your worth. I think this was mentioned in your earlier segments as well. Research. Research on industry standards for your role. Know what you're paid for that role in that region, and come to the table armed with that kind of data. It's going to allow you to present a strong case when you're negotiating for a pay raise or a promotion. And then the second is network and community. You need to build a solid professional network, both inside and outside your organization. These are the connections that are going to offer mentorship, help you work through challenges, help bring new opportunities to the table. And so really consider networking inside and outside your organization. And a big part of that can be joining inclusion resource groups or employee resource groups within your company. I am the co-chair of our Parents and Caregivers Inclusion Business Resource Group, and I can tell you firsthand that we work towards advocating for specific policy for parents and for women across the organization. Also, document your achievements. My sister told me many years ago, and I do it to this day, create an A-list folder in your email on your Google Drive. Document all those accomplishments. Use them in your performance reviews. Use them when you're asking for a promotion. Show where you've made a great impact across the organization. And finally, it sounds simple, but ask. You are never going to know the answer if you don't ask. Ask for that raise. Ask for that flexible work arrangement. Ask for higher, pay and promotion. That's going to be the key to maintaining your work-life balance, and you need to ask.
Yeah, as the famous quote goes, you miss 100% of the shots that you don't take, and so it's important. Put the shot up there. Shooter's going to shoot. Priya, thanks so much.
Exactly. Thank you for having me, Brad.
Coming up, the state of the housing market. I discussed with the chief economist of Realtor.com. Stay tuned. Sales of previously owned homes in the U.S. rebounded unexpectedly in February, advancing 4.2% from the month prior. That was well above analyst estimates for a 3.2% decline in sales. NAR Chief Economist Lawrence Yun says more inventory and choices are releasing pent-up housing demand. Here to dig into what this means for the spring home buying season, we have Danielle Hale, Chief Economist at Realtor.com. Great to have you back on the program with us. What do you believe is driving this unexpected rebound?
Yeah, I think it's important to put that rebound in context. So we did see sales pick up from January, but January had fallen quite a bit from December. And February's numbers, though higher, did not surpass what we saw in December. And they also trailed behind a year ago by about 1.2%. So it was a better than expected number, but still some gradual slowing in response to the fact that mortgage rates have been higher in recent months than we had seen them in last fall when they got down to almost 6% in September. So I think we're seeing some momentum shift. At the same time, the longer mortgage rates remain higher, the more that consumers kind of acclimate to this new normal. And the fact that we've seen mortgage rates kind of steady in recent weeks, I think bodes well for the spring buying season.
You know, that's great context, number one. And number two, as we think about the spring buying season, how are we looking at this kind of setup and what's expected to continue to transpire, whether that be on the mortgage rate basis, more tied to what we're seeing on the interest rate side in the 10-year, and how that could potentially unlock some of the potential demand that is still out there from new and first-time home buyers as well?
Yeah, so in 2024, we saw a really challenging season where mortgage rates dropped heading into the beginning of the year and then skyrocketed as we approached the spring buying season. So I think a lot of people got their expectations up only to have them dashed by mortgage rate trends in 2024. This year, we're almost setting up for the opposite because we saw mortgage rates climb heading into January, and they got very close to 7% again. Since then, they've relented a bit. You know, they're still not low by any stretch of the imagination, but they have come down. We're in the high sixes, 6.65%. As of last week's data, we'll see some new numbers later today from Freddie Mac. So we're seeing some gradual improvement, and that gives consumers, I think, an opportunity to better prepare for the market. They can set a budget and anticipate that it's not going to shift, and the numbers aren't going to have to change drastically throughout the course of the season. Though I would still advise that people should rate test their budget and see how fluctuations are going to impact their bottom line and the home price that they're looking for. But we're setting up for a more stable year, and that bodes well for home shoppers.
Okay, so would love to get your tips for home shoppers as they're perhaps checking that list and adding some new listings to it maybe, and trying to figure out how they can make sure that they're best positioning themselves, not just to go out there and put in some bids, but to also make sure that they're in a comfortable position over the longer term as well.
Yeah, I think that's a great question. So I talked about mortgage rates. We do expect a little bit more steadiness in mortgage rates, but it's still a good idea to prepare for higher rates just in case, so that way you already have a plan for how you might react. It's also worth noting that consumers have a lot of control when it comes to mortgage rates. You don't control the market, but you can think about the things that you can do to control your individual rate that you'll be quoted no matter the market. So improve your credit score, drop your debt or grow your income, make a larger down payment, which would improve your loan to value ratio and potentially get you a lower mortgage rate, or for the biggest possible savings, shop around for different rates among lenders, and that can also net you some big savings. The other thing it's not just for buyers, but also for sellers, is that the best time to sell a home is coming up. We have some very predictable trends in the housing market. It's a very strongly seasonal market. And we have looked at those historical trends and identified April 13th to 19th as the best time to list a home for sale. And if you're thinking about trying to hit that best time window, now is the time to start preparing and find your real estate team of experts to help you get your home to the market in the best week to sell.
Danielle, great to see you. Thanks so much for taking the time to break this down ahead of the all-important spring home buying season. We'll check back in.
Thanks for having me.
Coming up, everyone, traveling abroad is all fun and games until the hidden fees hit. The next guest that we have coming up on the program has some do's and don'ts for spending on international trips. That's next. 77% of global consumers plan to maintain or increase their international travel plans in 2025. That's according to American Express. For those heading abroad, there are hidden costs that could take a big bite out of your budget. Joining me now with some tips to save your wallet this summer, we've got Daniel Green. He is the co-founder and chief technology officer at Fay Travel Insurance. Good to have you here with us. What are some of those hidden costs that consumers might not think about when traveling abroad?
Absolutely. So every time you use your credit card or a debit card when you're abroad, you're often hit with a fee that you don't notice called a cross-border fee. That can be as much as 1% of the transaction. When you're traveling on a budget, that can really take a bite out of your spending.
And so how can consumers avoid those foreign exchange fees as well that you could incur?
So you can't always get away from the fees entirely, but there are a number of banks that will offer free ATM transactions abroad, and it's always worth talking to your bank or doing your research. There are a lot of them around. Some of them will even refund you. So if you get hit by a hidden fee, you can show them the statement, they'll give you the money back. And that can save you a lot when you're traveling if you want to work with cash.
So what are some of the do's and don'ts for if you run out of cash when you're abroad?
So firstly, it's always a good idea to have a few US dollars on you. Keep them stashed either in your suitcase or a money belt. It's a good backup, and most countries, people will always take it, at least at hotels. You should use local ATMs. Don't try and get the foreign currency abroad. It's usually cheaper to get it in the country. And at the end of the day, cash will always be king if you're wanting to save a few dollars in most countries.
What is the rule of thumb? As you mentioned ATMs, I got to ask, what is the rule of thumb for when it is a correct or safe ATM to use abroad versus one that might seem a little sketchy?
You're always better off going to an ATM that's associated with a bank. It's better to go during the day. It's better to go in public areas. Usually, if you're in the middle of a very tourist area and you see a little old ATM just outside of a corner store, those are the ones you should avoid, and definitely avoid the ones at the airport. They will always charge you extra fees.
So what are some of the top destinations where Americans can get the most value for their dollar right now?
So right now, people should really consider staying in the US, traveling domestically, not hitting any of these fees that we're talking about, and enjoying places like the great outdoors. But the US dollar is going pretty strong, and some of the best ways to do it is to travel, just not go to the main destinations. So go to Mexico where the exchange rate is strong. Instead of Cancun, maybe go to Cabo. Go to Portugal, go to Porto instead of Lisbon. The wine is great. It's a day trip to the main cities, and your dollar goes much further, where the euro is about 90 euro cents right now. And if you really want to go abroad, one of the best places in Asia right now is Vietnam. Plus, the added bonus, there's almost no direct flights, so you get to have a free layover somewhere in Asia as well.
All right. What are some tips to stay in budget then for any vacation?
So it's really important to try and agree and decide on the budget before you leave. It's much easier to be strong and make good decisions before the trip started than when you're standing at the counter and thinking, I really want one more souvenir. If you're paying with things like Apple Pay or Google Pay, you'll usually get real-time updates on your phone as to how much you've spent along the way, or check in with your bank app. Just as we said at the beginning, sometimes you're hit by hidden fees, and it's a good idea to keep track of how you're going. Don't look at the end of the trip. Actually look at some point in the middle. Pack light. You can always buy more clothes or do laundry. And if you are going to go to destinations, consider going to a ski resort in summer. You'll save a fortune. It's still beautiful. Off-peak times can be really powerful.
Daniel Green, thanks so much for taking the time here with us. Really appreciate it.
Thank you for having me.
We've got much more on wealth after the break. Stay tuned. You're watching Yahoo Finance. A programming note. On this week's episode of Stocks in Translation, Jared Blickery and Sydney Freed sit down with EY Parthenon Chief Economist Gregory Dacko to discuss how policy uncertainty is impacting the markets.
The unusual features of the last 4 or 5 weeks has been that trade policy uncertainty and policy uncertainty in general has surged to records that we had never seen before. To give you a number, trade policy uncertainty is currently about 90% higher than it was back in 2018, 2019, when we had the onset of the trade conflict vis-a-vis China. So it is an environment where there's a lot of uncertainty, and whether you look at consumer sentiment measures, at business sentiment measures, they're all pointing to the same thing. There's a bit of a wait and hold approach to not investing, not spending, because there's a lot of uncertainty as to how prices might evolve and how economic activity in general might evolve.
You can watch Stocks in Translation every Tuesday and Thursday at 8:30 a.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Let's do a final check of the markets here as we're taking a look at the major averages, and you've got the ticker scrolling across the bottom of your screen. We're higher across the board, fractionally as it may be. We're seeing gains for the Dow, the S&P 500, and the NASDAQ. The NASDAQ and the Dow up 0.5% each, and the S&P 500 adding on 0.3% during today's activity. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination. That comes up at 3 p.m. Eastern Time with Julie Hyman and Josh Lipton.